Thanks. Well, good morning. I believe that corruption is inevitable because corruption is profitable. There's never been a moment in the history of corporate life or corporate business where corruption hasn't been a pernicious influence. Because corporations are profit maximizers, they're tempted. There's almost like an irresistible urge towards corruption. And today in the United States, we've formalized this. We've normalized this into a kind of legal form of corruption. And the cost is great, and it's borne by all of the rest of us. It's borne by society. I wanted to start with this because this group is interested in blockchain solutions and applying the blockchain in novel ways, including decentralized governance. That might be an antidote to this pernicious form of corruption. The transparency and the immutability of transactions in the blockchain mean that that would be exposed. That kind of behavior would be exposed and therefore probably minimized. However, if you're going to delve into the blockchain and decentralized solutions, very quickly you're going to encounter resistance. A very typical criticism is that the blockchain solutions are inefficient. You hear that all the time, right? The blockchain itself is famously compute intensive. Moreover, decentralized organizations are cumbersome because everyone has to participate and vote. And so we look at that and some critics will say, well, that's very, very inefficient. What I want to show you today is that the current system we have is so spectacularly inefficient that the blockchain will look like a relief in comparison. I'm going to start with two incidents that are from the news. They're not connected, but they'll begin to illustrate the points I'm going to make. The first one, this is a photo of Sam Altman, the CEO of OpenAI, in his comments before Congress just a few months ago. And he did something extraordinary in this session. Here is the leader of the most influential and fast-growing AI startup in the world. And in his comments to Congress, he talked about the existential threat represented by this technology, comparing it to nuclear weapons and demanding that the government intervene and impose a layer of regulatory management on this industry. Now, this is unusual for two reasons. The first reason is that Silicon Valley companies are famously averse to any kind of interference by the government. They'd prefer not to be regulated, so it's quite unusual. The second thing is that Altman didn't stop there. He then went on to other nations, the capitals of other governments, and insisted that they too impose a layer of regulatory authority over this emerging field. So what's really happening here? There's kind of two theories. One is that this is an industry that is out of control. The technology industry right now is locked in an arms race, an escalating war, because each seeks to dominate the next platform, the new platform that's emerging. And this is literally an existential crisis for companies like Google and Microsoft. They cannot restrain themselves. The governance mechanisms at those corporations are unable to prevent these companies from proceeding in this arms race to escalate in artificial intelligence, even though they are fully aware that the risks are not fully known and they could be existential. These companies feel compelled to proceed. They cannot govern themselves. They need external regulation. They're demanding it. Now, there's a second interpretation. The second interpretation is more cynical. The cynical view is that Sam Altman is asking for regulation because he'd like to impose a regulatory barrier around the business that he's already built. Right? So he'd like to manipulate government into protecting his business. So that's example number one. Example number two comes from the news. It's also coming from Congress, not reflecting particularly well on our Senate. Senator Bob Menendez recently was indicted for bribery and extortion. And this is an example not of someone who's seeking control, but someone who's under control. And it's safe to say that our Congress is under control. It's under the control of private entities and corporations. There's so much money needed to run a national campaign or run a campaign for national office this field is rife with corruption. Now, in this particular instance, Menendez is accused of being under the control of the Egyptian government, acting as an agent for the Egyptian government, but of course there's a corporation in between that handle payments. And according to the allegation, his house was found stuffed full with hundreds of thousands of dollars in cash, gold bars, and his girlfriend got a Mercedes-Benz in the deal. So here are the very organizations being asked to regulate industry is subject to the whims and the control of those industries. I'm going to take you through a narrative about how these things connect. Before I begin, let me tell you what I mean by corruption. Corruption is the misuse of power for one's own gain. There's sort of two ways to look at that. One way is the classic quid pro quo. That is to say, I do something nice for you and you give me some cash on the side, under the table, in the form of a kickback or payola. It doesn't have to be cash, as it might be in the case of Bob Menendez. It could also be, let's say, the president of a country talking to the president of another country, trying to dig up dirt on one of his domestic rivals. There's a second form of corruption that doesn't involve the explicit quid pro quo or the exchange of value. That's institutional corruption. And that's where, and through sort of an insidious process, the institutions that apply order and regulate markets are gradually corrupted. We call this shadow politics. This happens out of sight. Most people are unaware of it. So there's corruption inside the corporation. Now, usually the governance mechanism here are the methods of protecting against things that are well known, problems that are well known by law students. You'll be familiar with the principal agent problem, why we have boards of directors there to represent shareholders, why there are audit committees and so forth. So there are a lot of governance mechanisms that add layers of inefficiency. They add layers of cost in running a corporation. That's to protect against corruption inside the corporation. But there's also mechanisms for governance outside, and that is what I'm going to focus on today, corruption outside the corporation. We see this in Congress right now. There's a war on consensus. There are parties that would like to see that the United States can never align on policy. And in some respects, the battle that's going on right now in the House of Representatives is a great illustration of this. The goal there is to defeat consensus so that it's impossible to govern. This is a secretive process. It happens out of sight. We're not aware of who all the players are. Dark money is involved, influence is involved, super PACs are involved. What we know is it doesn't serve the interests of the United States. It doesn't serve the interests of the people who voted these people into office. This process continues to this day. It is divisive. It splits us. It pits one citizen against another. And it's fabulously inefficient. Okay, I'm going to make my case with 6 chapters. First one, about information empires. So we live in an era of globe-spanning information empires. And I got interested in this when I was working on my book. My book, as mentioned in the opening comments by Raphael, my book is about dematerialization. Dematerialization is the process of replacing physical things with software. And that might sound a little esoteric. I use the term vaporize. That's the name of my book. And vaporize, but by that, what I mean is that you have physical objects that are here today and gone tomorrow. They've been turned into software. Now that, again, might seem a little strange, but every time you use your smartphone, you're vaporizing something. That is to say, every time you use an app on your phone, you're doing something that you used to have dedicated hardware, a physical product to do. Today, if you want to change the camera on your phone, you simply tap an icon and download a new camera software, and now you've suddenly got new camera capability on your phone. That we take for granted today. A whole generation's been raised on this. They don't think twice about it. But let me tell you, that was quite an extraordinary thing to accomplish back in the early 2000s. Your smartphone keeps getting smarter. Over the past 15 years, your smartphone has absorbed the feature functionality of more than 15 different consumer electronics devices and dozens of other physical objects as well. These are all products that used to be sold at retail in a box, shrink-wrapped, on a shelf. That no longer happens, and as a result, there's been a crisis in retail for the last 15 years as well. A number of national retail chains, more than 100, have closed. The companies on the receiving end of this process are the consumer electronics companies, the companies that used to make MP3 players and digital cameras and navigation systems. And those companies, in the first 10 years of the smartphone's existence, experienced a double-digit decrease in sales every year. For example, Panasonic in North America in 2008, more than 97% of their revenue came from consumer electronics. Less than 10 years later, it was about 3% of their revenue. That company has been completely turned upside down. Meanwhile, the companies that make smartphones and the companies that sell mobile apps and vaporize software, well, their business has increased 500-fold in that time frame. In the past 5 or 6 years, we've seen that space grow. So when I wrote my book, this was a $1.3, $1.5 trillion industry, this vaporized software business. It's grown now to $7 trillion. Actually, today it's closer to $10 trillion. So it's growing very, very rapidly. And of course, the companies that understand this and are at the forefront of it, they have emerged as the largest companies in the world. So back when I published my book in 2016, Apple was the leading company in the world. It was the most valuable company in the world, valued at about $570 billion. What's interesting about that is just 15 years before, in 2001, Apple was worth $5 billion. So they had a 100-fold increase in their valuation on the strength of the iPhone. But it didn't stop there. Within 2 years, Apple had added 50% to its valuation, and it didn't stop there. By the end of that year, by the end of 2018, Apple was the first company to cross the $1 trillion threshold in valuation. Folks, these are historic valuations. They were followed by Amazon. Just before the pandemic, in January 2020, this is where it stood. Apple was almost 1.5 trillion in valuation, and a couple of the other tech giants were approaching that trillion plus valuation as well. But then we all know, during the pandemic, values for tech companies went up, and then they crashed spectacularly last year. Where are we at today? Well, today, I need a new diagram. Because I need a new way to show this information, but it's quite extraordinary. Apple's at $2.7 trillion in value, Microsoft at $2.5 trillion, and so forth. So these companies are growing and growing. It doesn't stop. Now, people are speculating that Apple will be the first company to reach $5 trillion in valuation. Again, the company was worth $5 billion in 2001. This is an extraordinary run. Others speculate that Amazon or Microsoft might reach that multi-trillion-dollar threshold as well. How will they do that? What is the next industry they're going to vanquish and dominate? When I wrote my book, I spoke to Kevin Kelly. He's executive editor of Wired magazine, and he's written a number of excellent books. And he shared this with me. He said, we're at the dawn of the third platform. The first platform was the World Wide Web in the 1990s. Fortunes were created, new companies were created. Then the mobile revolution happened toward the end of the 2000s and in the 2010s. That's the period I was just talking about a moment ago when we began to vaporize physical things, replace them with software. And the next platform, we will digitize the entire world. And I know this is true because that's what I'm working on in my own practice right now, building large-scale digital twins of airports, harbors, and entire cities. So we're starting to replicate the entire world in software. And Kevin Kelly continued. And he said, whoever dominates this grand third platform will become among the wealthiest and most powerful companies in the world. Now, these are the companies that are locked in a struggle to dominate artificial intelligence right now. These are the companies that I mentioned a moment ago are out of control. They do not have a governance mechanism to allow them to manage this development safely. They are demanding external regulation to manage their growth. These are the largest and most powerful companies today. But also, they're not necessarily the largest and most powerful companies in history. And to understand that, I have to talk to you about corporate empires. So when we think about the largest and most powerful companies in history, they're not the tech companies today. They're the very first modern corporations, the very first joint stock companies, the very first global trading companies, and the first companies that were publicly traded on a stock market. They are, of course, the Dutch East India Company and the English East India Company. That VOC, that's the initials for the Vereinigte Oost-Indische Company. It's the Dutch version, VOC. And they have these great logos. These two companies effectively outsourced global conquest on behalf of their nations. So at the time, England and Holland were quite poor, and they were locked in a global struggle with Spain, which was the richest empire on the planet. And so Queen Elizabeth commissioned the East India Company effectively to do global conquest in the cheapest way possible, which is to outsource it to private industry. It sounds familiar today. The business model is simple. It was an exclusive license to go dominate another place in the world and to manage the populations and that economy for profit. And these two companies did this in a ruthless way, in the most ruthless way imaginable. First, they were hyper-centralized. Less than 20 men in Holland decided and determined the affairs for a population of billions in the eastern part of the world. They issued their own currencies. They had their own navies, their own armies. At one point, the Dutch East India Company and the English East India Company had armies that were greater than their national armies. They fought wars against each other, by the way, 4 wars against each other. And at its peak, the Dutch East India Company was the most valuable company in history. Now, theirs is hotly contested, so I have to say that this diagram I'm showing you, there are many people who dispute it. But the concept that they were trying to make a rough correlation between the valuation of the Dutch East India Company at its peak, which actually occurred quite a bit later than this, than 1637. It occurred closer to 1700. But at the time, it was valued at something on the order of $9 trillion in US dollars today. And at that time, it would have been greater than the value of all those tech companies on NASDAQ. This, again, is contested because it's quite hard to make that correlation with a company from 400 years ago. The Dutch East India Company was eclipsed by the English East India Company, and particularly that occurred when the English secured control of India in the 1750s, and they began to loot that country. India at the time was the richest country, richest nation or empire in the world. And the way the British achieved this is through bribery and corruption. They bribed and extorted the Mughal emperor, They bribed and extorted princes and shahs. And most famously, they bribed and extorted the English Parliament in order to maintain their monopoly for hundreds of years. So corruption came hand in hand with conquest and domination. This is not the only place in the world where this occurred, by the way. These kinds of companies, these companies designed for global conquest, were sent out on missions all over the world to varying degrees of success. But we, looking back today, can say that all the countries in green on this map were at some point or another were dominated by English companies or by English nations as part of European empires. Only Japan, Korea, Thailand, and a couple of other countries escaped European domination. Now, when I was a child raised in the United States, I was taught that Christopher Columbus was a hero of sorts, that he brought a kind of enlightenment and civilization to the New World. This we now know is untrue. This is no longer taught that way. He was a ruthless murderer, and he brought brutality and domination to the Americas. The real story of this conquest was bloody and gory. It was about the devastation and degradation of people. These too are corporate values, unfortunately encoded into the DNA of corporations today. These companies set out on a global conquest to divide up the planet, and that notion for conquest, for winning at all costs, is still reflected in the arms race that we're seeing in artificial intelligence today. Now I want to talk to you about the concept of decentralization and the constant friction with the need or the urge, this kind of gravitational force towards hyper-centralization. The two things are in constant tension. So while all that global conquest was happening, the American colonies were being formed as well. We tend to forget this today, but America was a corporation before it was a nation. The Virginia Company was the first American colony that the English created, and it was a corporation. The Massachusetts Bay Company, much more successful, it lasted longer. Massachusetts Bay Company was also a corporation. What's interesting about the Massachusetts Bay Company is that they experimented with decentralized governance. It wasn't perfect by any means. It was a very early experiment. In 1629, this charter for the Massachusetts Bay Company created a voting mechanism that was unprecedented for a corporation, in the sense that it wasn't just shareholders who could vote, it was actually all of the residents who were male and white. But all the residents in that region were able to vote. This is a very unusual mechanism for governance at the time. And there was also a body of liberties attached that came in 1640. This is 40 years before the English had their own Bill of Rights and before any other country had a Bill of Rights. There was a kind of prototypical Bill of Rights that provided people from illegal search and seizure, the right to a fair trial, the right to a speedy trial, the right to the protection from double jeopardy, and so forth. Now, what's interesting about this prototypical constitution that was introduced as a part of the corporation, the Massachusetts Bay Company, is that it was copied by other colonies. Other colonies, so for instance, as Connecticut broke away and as Rhode Island broke away, they mimicked this, and then they drafted it and they improved it, and they wrote their own thing. So for instance, in Rhode Island, they introduced the concept of religious freedom and so forth. I'm not here to tell you that these were perfect. These were prototypical experiments. You could think of the American colonies as kind of a time of incubating new ideas, and they were hotly debated at the time. Of course they didn't include everybody. Of course they didn't include Native people, enslaved people, or women. 3/4 of the population was not included with rights under these agreements. That's definitely true. But this was a form of decentralization, prototypical decentralization, at a time when in Europe, the royalty were focused on the absolute right of kings and the concept of an absolute monarch. They were going the opposite direction, towards hyper-centralization. And of course, that friction continued. Eventually, it touched these shores. When the English East India Company was given the right to import tea into the United States, the American colonists were quite aware of the reputation that the English East India Company had. They had no desire to invite it into these shores, and they fought it fiercely. And that is actually the origin, the conflict that we today call the Boston Tea Party. At the time, it was called the destruction of the tea, because the idea of importing tea from a global monopoly was considered a form of control. And they were afraid to allow that monopoly to have any roots in North America, and so they fought it. Of course, the English Parliament retaliated with the Intolerable Acts, and that is the sequence of events and consequences that led to the War of Independence and American independence. And so we like to think of this then as a kind of like, the birth of this country. When we wrote the Constitution, the reason our founders were able to write the Constitution so quickly is that they didn't have to write from scratch. They had existing constitutions from 13 colonies, and they can compare notes about what worked best. And they voted simply based on their own experience in their own state or their own colony. What had worked well, and that was how we were able to arrive at consensus. So we like to think the story ended there, but of course it didn't. Hypercentralization and decentralization are locked in a permanent conflict. Decentralization is a process. It's never done. And so if you're truly interested in decentralized governance, trust me, you're going to be on that treadmill for an awfully long time. It never stops, because the forces of centralization, they are unstoppable and unquenchable in their desire for control. Within a generation of the founding of the country, we began to industrialize the United States, and that started to create class conflict. A handful of people benefited tremendously, others were wage slaves. This created tremendous tension in Washington in governance, because a Supreme Court judge at the time was paid $10,000 a year. He could have earned a salary of $1 million a year working for one of the trusts. So there was a dilemma there for the most talented people in government. This cartoon shows you a picture on the right side of a policeman in New York being bribed by Tammany Hall, and of a senator on the left side being bribed by the large trusts. It was well understood by the 1870s that the railroad trust and other trusts dominated Congress. Here you see a picture of the Senate dominated by corporate interests. Toward the end of the 19th century, a new concept emerged, which is that the federal government has a role to play in managing the growth of these large organizations. They can expose the greed and corruption. And we began to pass laws. For instance, by 1875, it became illegal to give stock to congressmen. It's kind of astonishing that you could freely give them stock before that, but that was actually how business was done. By the time the progressive era emerged, people began to demand government action, and they got their answer when Teddy Roosevelt used the new antitrust laws to begin to break up companies. The government started to put some teeth into the enforcement of these anti-monopoly laws, and we started to see the federal government take on this role as a trust buster. By the middle part of the last century, the 20th century, we began to set aside that hammer, the Federal Trade Commission, and the U.S. adopted a different attitude towards government. We began to tolerate large-scale companies. In a moment, I'll show you exactly what I mean. We arrived today at a situation that's very analogous to the one that we saw in the past. The largest lobbyists today, of course, are the big tech companies. And so, in a weird way, we've kind of recreated. But what you can see is this pull, this tension between decentralization and re-centralization. It's inevitable. It's ceaseless. What's kind of interesting in our time is that some of the companies that were broken up during that progressive era, they've reconstituted themselves. It's like the Hydra. You can cut off the head and it'll grow back another head. Here on the left side, this is a hard to look at diagram. I'll explain what you're seeing here. On the left, you can see Standard Oil, John Rockefeller's company. The energy monopoly was broken up in 1911 into a series of regional operating companies. But by the 1990s, they began to recombine and reconfigure themselves until finally companies like ExxonMobil and BP emerged, and these are among the largest companies in the world today. Something similar happened in telephones, right? So famously, we broke up AT&T. Again, this is like a eye doctor's chart, so I'm going to zoom in on it so I can show you just one part of it. At the top of that chart, you can see that AT&T was broken up in 1984 into regional Bell operating companies, and one of those companies, Southwestern Bell, began to acquire the other operating companies over a period of time, and by the 1990s, they had reconstituted themselves. They acquired AT&T Wireless, they acquired what was left of the original AT&T, rebranded the company, and lo and behold, AT&T is back. Now, we tend to think, well, okay, those big companies, telecom, I don't know, it doesn't really touch my life that much. When you go to the grocery store, you say, well, gosh, there's more than 100,000 items for sale in a Walmart supercenter. Surely this shows us a great decentralization, right? There are so many brands on offer. Folks, I'm here to tell you that's not the case. What you have in a retail shop is the illusion of choice. 11 companies dominate consumer goods, food, and beverage. Just 11 companies own most of the brands that we buy. 7 companies dominate the beauty industry. 182 different companies are combined. 10 companies control 91 fashion businesses. 1 company owns 80% of the eyewear business. And now you might be thinking, well, okay, fine, this is about fashion and consumer. How important is this as a sector? In fact, it covers every sector. This kind of consolidation has been the name of the game for the past 30 or 40 years. In the 1990s, there were 37 companies in banking. Today, there are 4 national mega banks. In the 1980s, There were 38 semiconductor companies. Today, there are 3 leading semiconductor companies. In the media business, when I began in the 1980s, there were 50 major companies in the media business. Today, they've been consolidated down to 5 major media conglomerates. The automotive industry used to have 60 different brands that competed. Today, they're dominated by 14 companies. And the defense industry was 80 different companies in 1980, and they've been merged down to 5 leading companies. So clearly, this trend of consolidation spans almost every industry in the United States. In the last 20 years, we've seen consolidation in 75% of the industries in the United States. The story doesn't end there. There's another layer to the story. You'll recall that during the late 1800s, the economy was dominated by trusts, the money trusts. And they had a particular interlocking structure so that those trusts could coordinate their activity in Capitol Hill and coordinate the business, those operating companies as well. Something similar is happening today. How many folks are familiar with Vanguard, BlackRock, and State Street? You know exactly where I'm heading. You know exactly where I'm heading. So these are passive money managers. They manage enormous amounts of money on behalf of individual investors. Vanguard has $8 trillion of assets under management. BlackRock has $10 trillion under management. And State Street has $4 trillion under management. Now, Vanguard and BlackRock together comprise the largest shareholding interest in most industries in the United States today. So it's not just consumer, it's not just fashion, it's not just food. It applies to materials, energy, financial, and many other fields as well. They are the largest shareholders. And you know, it may seem to you, when you look at this and you say, well, 14%, 12%, the way stock ownership is in the United States today, when a company goes public, the ownership is so distributed that a 10% stake is by far the largest stake in the company. So anyone who has that stake or anything near it has a controlling interest. And again, if you're the CEO of one of these companies and a company in one of these fields, you have to pay attention to BlackRock and Vanguard. You can't ignore them because there's going to be a time where you have capital needs and you're going to need those companies' support. So some people consider these systemically important market utilities. Now, that's an important phrase. It comes from the Dodd-Frank law. BlackRock and Vanguard fiercely resist that designation because if they were so designated, they would then be subject to those laws. But it is true that they are among the largest shareholders in exactly 100% of the large companies in the Fortune 500. And in most cases, in 84%, either BlackRock or Vanguard is the largest shareholder, the largest individual institutional shareholder in those companies. Now, State Street is the 3rd largest with $4 trillion under management. You might wonder, well, who owns State Street? The answer is BlackRock. And then you say, well, let's think about BlackRock. Who owns BlackRock? The largest owner of BlackRock is Vanguard. This idea of interlocking ownership interest is a recreation of the great money trusts of the 1870s. These are the new trusts. And they do coordinate policy. Here's an actually stunning revelation from the former CEO of Vanguard. Bill McNabb retired just a few years ago, but he said this before he retired. He said, in the past, some have mistakenly assumed that our predominantly passive management style with respect to stocks suggests a passive attitude with respect to corporate governance. Nothing can be further from the truth. So if you recall, a moment ago I talked to you about the less than 24 men who controlled the Dutch East India Company in the 1600s. Well, we've recreated that today in the United States. It's Vanguard and BlackRock. These companies control what corporations do. Now, you'll hear some people say, yeah, and they're pushing for stuff like ESG, and they're pushing green policies and so on. They're pushing a liberal agenda. That's also not true. So when we look at critical votes, corporate resolutions that pertain to climate change or climate policy, we can see that Vanguard and BlackRock can ensure, with their voting power, they can ensure that these resolutions are defeated. They've done it again and again and again. We pay a price for hyper-centralization. We, the citizens of the country, pay a price. We pay a price in the form of higher costs. When there's less competition, there's higher prices, and that's manifested in a number of fields. Here I've listed a few of them, but there are many. So we have the most expensive healthcare in the world with, candidly, embarrassingly bad healthcare outcomes. The United States isn't even in the top 30 in terms of healthcare outcomes. We pay twice the price of most other places. Of course, we have the most expensive pharmaceuticals. We pay twice as much for broadband and for mobile telecommunications as Europeans do. Why? Let's take a look at this. The price of spending on drugs has risen rapidly. That's not news. Anyone knows. Anyone who's been to a drugstore is well familiar with that. And this also occurred in the same time frame, from the 1990s onward. By capita, per capita by country, you can see that we pay almost twice the price as some countries in Europe, some companies in Europe. But worst of all, most pernicious of all, is that Americans can't afford to pay for their own health care. Many Americans, 3 in 10, can't afford to pay for their drugs, so they either take fewer doses or they skip the drug altogether. This is an extractive economy, right? So we're being, in a way, harvested for fees by these corporations. It extends to many other fields. For instance, let's talk about airfare and air travel. To come here from Los Angeles, I had a choice of one airline. We all know there's big 4 airlines that dominate the United States, and if you're on one of the main routes, you can get a decent price on an airfare. But my airfare to come here from Los Angeles, halfway across the country, was twice the price of flying cross-country on the routes where there's real competition and the prices are reasonable. I paid twice the price for that flight. Now, the costs have gone up across the board in the United States for air travel. We pay about 10 to 12% more than one would expect, and the comparison there is Europe, where there is real true competition between airlines. U.S. airlines, since the pandemic, have generated twice as much profit as European airlines. So the two things are connected. On routes where there isn't much competition, where there's 1 or 2 carriers, we experience terrible service, more delays and longer delays as well. And so you have service degradation and price rising. These are the attributes of an oligopoly or a managed economy. That's not the only way we pay. We also pay more fees, more junk fees. You hear a lot about that from Washington right now. These large companies don't invest as much in R&D. I'll show you that in just a moment. That means there's less innovation and less overall growth in GDP. They also pay lower wages because there are fewer employers. That leads to massive inequality, and they enable corruption on a vast scale. I'm going to take you through these things in just a moment. First, here's this very difficult to read chart. I'm going to take a second to explain it, but it's quite a powerful chart. I wanted to share it with you. So let's take the top row. On the top left, you can see here market consolidation in manufacturing and non-manufacturing. And so as you can see, it's gone up. No surprise. I've been talking about that for 5 minutes. Then there's the after-tax profit. And as you can see, the after-tax profit in that same time frame, since the 1990s, has almost doubled. So these companies are definitely making more profit. One way they're doing that, if you look at the bottom left, is that they're paying employees less. Wages have stagnated or even gone down. And over here, they're investing less. US companies used to spend on average 30 cents of every dollar of profit would be reinvested into innovation. Today it's 20 cents, so about a third of that has been reduced. The idea of income inequality is well established. I don't need to dwell on it here, but it dates right back to that same time frame. Since around the 1980s, 1990s, wages have stagnated in the United States. That's one byproduct of having fewer employers in the marketplace. But even more pernicious is the gap in the distribution of wealth, not income. So the red on this chart shows you the gross disparity in wealth in the United States, and 10% in this chart owns 70% of the assets. Here's a better illustration of it. This chart shows it much more clearly. The top 2 stripes are the wealth that is owned by the top 10% of the United States population. That light green at the very top, that's just the top 1%. And then here at the very bottom, that dark line, it's very small. You might not notice it. It's just a line at the very bottom, and you notice it dwindles. That's the wealth that's owned by the people who are the bottom 50% of the population. Here, I've circled that to make it even clearer so you can see the distinction here. And if you think about what I've just described, how a handful of companies invest and manage corporations, and they do it across multiple sectors, and they're earning fantastic rewards, well, who are their shareholders? Who are the investors? Whose money is at work? It's not evenly distributed across the country. It's not evenly distributed across the population. So the wealthy are getting wealthier through this process. It works for them. And one thing we know from history is that when people get richer, they tend to get the laws that favor them. There's another even more insidious aspect of this that I think should be even more troubling. For a number of years, economists have been wondering why GDP growth has been dwindling. So the growth in real GDP in the United States, historically, through most of our lifetime, before in the 20th century, historically, it was about 2.25%. It averaged about, of course, it fluctuates tremendously, but if you average it out, the growth historically has been 2.25%, which doesn't sound like much, but bear in mind that no country on earth has been able to sustain real GDP growth at a rate higher than 5% for more than a decade. So sometimes you'll see certain countries, for instance, China most recently, had spectacular growth rates in the 6% range, but it's hard to sustain that for more than a decade. It's very rare. So 2.25% is actually quite steady state. And of course, this is compounding, right? So you're growing wealth for everyone. Effectively, you're growing standard of living for everyone in the country as you grow real GDP. But when you stop investing in innovation, when you cut off investment in making companies more efficient and focus on novel technologies that propel them forward, well, you start to cut into real GDP growth, and that's exactly what we've seen. Since 2000, real GDP growth has dropped to 1%. That's effectively wiping trillions of value out of the economy. That means we're all poor. We all bear cost. Now, you might wonder how this occurred, and that's what I want to explain now. Institutional corruption is legal in the United States. So back to Senator Menendez. It's an illustrative case, but it's not the only case. This is a widespread activity. You know, when you think about the job of an elected official in Washington, particularly a senator or a congressman, what do you think they do all day long? You think they're writing policy? You think they're attending to the people's business? In Senator Menendez's case, a U.S. senator has to raise $14,000 a day in order to, if he or she wants to be reelected to office. $14,000 a day. Can you do that? That's a stunning accomplishment if you think about it. These people are money machines. That is what they do. They're handling huge sums of money every single day. So it's no surprise, eventually they're tempted, some of them are tempted to put a little of that money in their pocket. This seems like actually kind of an obvious risk in the way our government works, the way our election policy works. More than 90% of our members of Congress have their own political action committee in addition to an election campaign committee. That means they have fundraising business on the side. And they spend on average 30 hours a week raising money. It makes you wonder how much time they have left for the people's business. Where does all that money go, all the money that they're raising? One place corporate money goes is to lobbying. In the past 5 years, the largest companies in the United States, the 200 largest companies in the US, have invested more than $1 billion a year in lobbying. So it's a big business. What they get for it is almost $5 trillion in subsidies. This is taxpayer money that's redistributed to these companies. So they get almost $1 trillion a year in subsidies. There's your quid pro quo. How do we arrive here? Some people talk about the Chicago School, but maybe we should think of them as the Chicago mob. These thinkers from the School of Chicago have influenced the way our policy leaders and our Supreme Court think about the law and how they apply it to corporations. Milton Friedman very famously in the 70s coined this phrase, the social responsibility of a business is to increase its profit. This is like a license to kill for a sociopath. The idea that a corporation has absolutely no responsibility to anyone besides its shareholders. And this is how we arrive at companies that treat the environment like a toilet or a trash bin and treat their workers so poorly that they have to apply for food stamps in order to pay for their bills. Robert Bork, before he became a federal court judge, wrote a famous book called The Monopoly Paradox, in which he submitted that the only way to measure monopoly is not the size of the company. The government should not intervene to break up large companies. The only way to measure monopoly is through price theory, what he called a consumer welfare standard. So if corporations are not raising prices unduly on the people who pay for their products, then they can't be considered a monopoly and there should be no government action. It's astounding to me how deeply rooted this concept is. You may believe this yourself. If so, you've been indoctrinated by the Chicago School. This was not the way of thinking in the 1950s in the United States, in the aftermath of the progressive era and President Roosevelt's era. We had a sense that the government played a role in breaking up and managing big business. Today, government facilitates big business as long as they don't raise their prices. That's why you'll notice in the examples I gave you, the prices only go up 10%, 12%. They're not doubling prices on us because that would call the attention of the government to them. The third is Antonin Scalia. When he was a Supreme Court Justice, achieved something that was really quite extraordinary. We often hear conservative people complain about judicial activism, legislating from the bench. And perhaps the most spectacular example of this came from Antonin Scalia in the Citizens United case. In this case, a conservative group had created a documentary film, and the Federal Election Commission brought suit against them. I'm not going to get into the details of the case, but what's interesting about it is that it made its way to the Supreme Court where they heard the case. And in the process, Justice Scalia asked the government attorneys a series of questions that they were not prepared to answer. The case that was brought before the court was very narrow. Ted Olson was arguing very narrowly on behalf of Citizens United, and the U.S. government was prepared to argue that case, but they were not prepared to argue the larger case, which was about free speech rights. And so the justices insisted on a second trial. This is extraordinary in the history of the United States. They decided the case, the government lost, but then they had a second hearing, a second set of hearings 3 months later, where they investigated the question of whether the government had the ability to regulate speech at all for corporations. And in the process, as we all know, the outcome was that corporations have the same rights that humans have, human citizens have, free speech rights. This is a question no one asked the court, but Justice Scalia was super interested in the idea. Since that time, corporations have had no limitation on their ability to speak in elections, and speech here in this case is money. And so you can see right after that decision was made, Citizens United in 2010, that's the red circle in the diagram, you can see that the cost of running elections in the United States began to rise inexorably, outpacing the growth of GDP, which it had been historically in line with. And since that time, just since 2014, we've seen the cost of ad spending go up double to $6 billion. We never used to spend $1 billion on an election cycle in the 2000s. Billionaires are involved, so people with money speak more, they have more speech. And you're starting to see now situations where, say in the 2016 election, the top 100 donors donated by far most of the money in these billion-dollar campaigns. Senators understand how this works. They're very attuned to it, so Menendez is not the only one who's paying attention to this. The senators who support military spending, in this case, who have voted in favor of it, they reap 7 times the rewards of those who vote against. This is obvious. As I was preparing for this, I noticed this. One researcher said it was unlikely that the Chicago View would have spread so fast and certainly would not have dominated the jurisprudence for so long without the financial support of powerful economic interests. This is what people are concerned with when they see Supreme Court justices flying on private jets to gatherings with oligarchs. This is exactly what they're concerned. The optics here are terrible for our country. It looks like big business is influencing the Supreme Court. I also want to talk about regulatory capture, but I'm cognizant of the fact that I'm under time and we have to move on to other topics. Let me just say that regulatory capture is another consequence of consolidation. We hear about the revolving door between the SEC and other financial regulatory bodies, but it's not just there. You see the revolving door everywhere, the Food and Drug Administration, the CDC, the Copyright Office. Executives from industry that understand industry, they have ties to industry, are brought in because usually the way government looks at it is they know the best about that industry. The problem is they're normalized to the conduct of that industry, and so that's gradually how we begin to adopt this into policy and into our regulatory practice. In a way, we're normalizing corruption. And you could say the same about just about every government agency. So there have been allegations of regulatory capture levied against each of these organizations, each of these federal agencies. The way I look at it, it's not so much a revolving door as an ejection seat. Moneyed interests get the regulators that they want, and they get rid of the ones they don't want. So as you can see, Senator Menendez is a tiny part of the problem. Now here's an interesting thing. If you look at that case against Senator Menendez, they haven't indicted him for bribery and extortion. They've indicted him for conspiracy. And why is that the case? I mean, obviously the guy has gold bars in his garage at home. Like, clearly he was paid off. The reason they're bringing the case that way is that the Supreme Court decided just a few years ago in a case a corruption case that was brought against a Virginia governor. They decided to narrow the definition of corruption. They narrowed it so much that it's actually quite difficult for the government to bring a case against an elected official. And so conspiracy charges are going to be easier to prove. And it's very likely, it seems to me, that they're going to find Menendez guilty. But nevertheless, the point here is that the government itself has been hampered by the Supreme Court in its ability to police this kind of corruption. So what you have is industry consolidation that leads to regulatory capture, it leads to legislative inaction and an inertia, gridlock on Congress. and a series of favorable judicial decisions that enable this kind of activity to proceed. So let me conclude with this idea of a choice, because I think that's really what we're here to talk about today. What do we want to choose for our future? It's our country. We get to decide. So a moment ago, I shared this thought from Kevin Kelly, which is about the future. How will our digital businesses grow in the future? Will we continue to consolidate? Will 5 big companies continue to dominate the tech landscape into the future? Will they attempt to replicate the business model of the English East India Company by extracting monopoly rent from everyone who lives in their digital domains? See, we don't have a Bill of Rights that extends to the digital domain. Instead, what you have in the digital domain are what we call contracts of adhesion, those click wrap agreements that we click on without reading, the 50-page agreements that you get when you use the App Store, or when you install a new piece of software, or when you sign up for an online service. Nobody actually reads those things, and they're called contracts of adhesion because they stick to you but not to the other party. The other parties are free to change them and update them as they do frequently. The end user license agreements, the terms of service, and so forth. This is what we have instead of a Bill of Rights in the digital domain. And I believe that anyone who's interested in blockchain and the idea of decentralized governance, I think you might care deeply about these particular contracts. That's where Web3 fits into the picture. And that's really what we're here to talk about today. The Web3 communities, blockchain communities that are built in a decentralized fashion, embody certain values. Open source software, the idea that it's controlled by no one, but it's open to anyone who wants to participate. They're geographically unbound. Innovation can occur any place. There's no permission required to innovate in these systems. They're open for participation. And they're founded on consensus, decentralized consensus. And yes, it's difficult to achieve. And yes, the process of voting in a DAO may be cumbersome, but I think you'll see in light of what I've just shared with you, as inefficient as that might seem, we stand to gain tremendously if we adopt that. And so for the future, we face a choice. And the choice is a series of values that are embodied in our system. And the question I'd ask you to consider in closing is, what values are optimized in the system that we have? And whenever we optimize for one set of values, of course, at the same time, we're minimizing a set of values. For instance, a market economy will optimize for efficiency and minimize the value of equality. A globalized economy optimizes for scale. That's why we see globe-spanning information empires. And of course, it minimizes the value of local community. An information economy optimizes for data collection, what they call surveillance capitalism, and it minimizes the value of privacy. And an attention economy optimizes for narcissists. Just think about who has the most followers on Twitter. It minimizes the value of consensus, and that's why we're riven with so much conflict in this country today. So as we contemplate Web3 and decentralized governments, consider that when you think about those systems, what you're really seeking to do is optimize the value of consensus and minimize corruption. Thank you. It's been my pleasure to visit with you and prepare these remarks for you, and I hope you have a very fruitful discussion about decentralized governance. My name is Robert Tercek, and I'm the author of Vaporist.